some gas. Grab that cash with both hands and make a stash.
Ladies and gentlemen, you can see we have successfully scanned in our documents as we professed we would do, and we've created a presentation that will show you how they compare. So I'll close those scanned documents out. Here is my actual life policy from Primerica, zoomed in at 100%, you see there. Started on 2/17/08, $400,000 coverage. I did come out as preferred at $42 a month. Right below that, I've made this into one large document. You can see where my scanner gets a yellow tinge there. That scanner's been around for some time. But you can see where this policy is the first proposal that was given to me from the unnamed life insurance company. That their name shows up here somewhere. But you can see they offered to me a contract where they were going to give me $100,000 coverage for $1,724 a year. So let me Alt-Tab as our switch over to, I have to go back into that document and open it up separately, and then we'll switch documents. But you see, I go to my documents, life stuff we've got, and here's that whole life versus term and investing, the difference. So with that, you see now, and I can switch between documents. We'll switch here. There's the compare policies, and there's the first one they had for me. I've scanned in. And then here's the second one, $184,000 in coverage. But let's switch back to the comparison for whole life versus term and invested difference. You see here, $109,000 policy. Towards the end of the 20 years on that policy, they would have a benefit of about $162,000. So it's an appreciating or a continued growing policy. They'll get me to $162,000 in coverage. That would cost me it would cost me about $1,200 a year for that term, term contract. To have the same term policy would cost about $1,200. That would be age 55, because you can see here I'm age 35 when this proposal was made. Their annual premium is $1,724. That goes through until age 77. And here is the outlay that I would have paid for that premium. Here's what they say I might have. Again, this is the non-guaranteed illustration. You can see that is up here. We've got to switch windows by selecting this option. And it says asterisk, asterisk right there. And you scroll down what the asterisk says. It says non-guaranteed illustrations. But they do guarantee a certain amount here. And I've copied. They've got all 20 years listed, all the way up through 77 actually. And we've taken the main years so that we can run a more smooth comparison. But it makes sense when you see here that their guarantee there in the first 2-3 years. All right, we'll switch back. We're going to compare that to what you would get if you invested the difference in from a term policy and invest the difference yourself. So you see here, $1,724 through 20 years. At the end of 20 years, they do guarantee $30,000. Well, I've paid $34,000 for that. And I could have as much as $55,000 non-guaranteed. I've seen what they actually return, and it never ends up being that much. But they do show that at age 60, I would have about $40,000 guaranteed and $51,000 guaranteed, or up to $74,000 guaranteed at age 77. Let's compare that down here, what you see with a term policy where we purchased the same amount of coverage. Actually, this is a $200,000 policy for 25 years. Would cost $441. This is not preferred. This is standard. If you got preferred, it would be less than this. Or smoking would be more. But we'll just go with the standard. That's $441 a year. Would give $200,000 coverage for a 35-year-old starting at age 35 and be covered through age 55, through age 60, because this is a 25-year policy. So you can see the total amount that it would be earned at the end of the year if you were to invest that money. Well, in 1 year, if you just, because you start off with that money, you turn around and invest it, a year later, you would have $1,445. Well, the first year here, there's nothing in the account. I guess that goes to commissions and marble floors and other nice things that insurance companies need. Second year, I've got $1,296. Third year, $2,631. Well, third year here, I'm up to almost $5,000. Let's jump down. We jump down to the 19th year. It still continues to grow. They've got $28,000. I've got $30,000. And you can even go up here to this is year 25 at age 60. You can see that's 25 years, age 60 here also. Here I've got $98,000 compared to what they even get guarantee is 28 versus what they say you might get if you're lucky, if they feel as though they're going to give a little extra, which is not typical. So then at 20 years you have 55,000. Well, down here you can see in 20 years I should have 112,000 just based on the average stock market returns at 12%. I can show you a long list of mutual funds that average at least that amount, and the stock market itself averages 12%, as we've shown illustrated time and time again, as does the Dow Jones and that's the S&P. Both of those average about 12% since their inceptions in the early 1900s or late 1800s for the S&P. So at age 60, it's interesting, I will have about $214,000 versus what they guarantee here would be 40 and maybe 88. And I've seen the illustrations again show they actually give a percentage return. It's right around 3 to 5%, maybe 6 in a couple years. There were 3 years they gave 10%, but those 3 years they gave that 10%, the stock market averaged about 25%. So there's 15% profit somewhere that went to somebody but not to the client. So then you can see here at 77 years, they guarantee you'll have $74,000, almost $75,000, and maybe $319,000. Well, what should you have if you just kept your money invested at 12%? At 77 years of age, that'd be 42 years into this investment program, which is just a mutual fund. At any time, it's always your money. You take out as you need to anytime during that time at no penalty to you, especially after age 59. There are penalties you pay for early withdrawal like you do with any withdrawal because it's taxed. But age 59 with an IRA, you could get these tax deferred. So we've got $1.7 million now in our account versus where they guarantee $74,000. Or if they felt nice, $319,000. Let's go down to the next example. As if that wasn't enough, let's continue. They did life policy. You can see where I would have to have an insurance benefit of $563,000 at 20 years in. Well, we put this at a $600,000 policy that would cost $975 a year. That's $600,000 in coverage for $975 a year, guaranteed for 20 years, and that's set level through 25. Historically, with our company, would say stay level for 25 years. It would cost $4,772 out of your pocket that you could invest, but we're going to invest that difference. So the $975 plus the $4,772 is your $5,747 they want. At the age 25 years into this contract, age 60, now you have $796,000 in your pocket. Stop paying for the insurance. You've got enough money invested on your own. You might consider canceling it at year 20, but we paid out through year 25. Now you can stop paying for it. Now you're investing the full $5,747. At age 65, 30 years in, you'll have $1.5 million. At age 77, you will have $6.4 million. Again, not guaranteed. None of these are actually for any of these other than these low-end numbers. But they can guarantee these numbers because they know more than likely they're going to make at least numbers in this area and give you that much. $6 million they know they can earn. Give it a 10% return, you're still going to get around $5 or $6 million. It's really a bad way to plan for your retirement, considering that this is the most they'll guarantee. They do put these interesting projections out there. But this, ladies and gentlemen, is what many life insurance companies will have you do with a whole life policy. Variable universal life policies are not much better. Universal life policies are worse because they do let you pay less, and ultimately it ends up costing you all the money you put in because the premiums are coming out of the cash value. So that just gives you a good overview of what it is you should be doing with your money to invest if you just put your money into a normal and average mutual fund.
Money, it's a gas. Grab that cash with both hands and make a stash. New car can be out. Money, it's a gas. Grab that cash with both hands and make a stash. Money, it's a gas.